Economics. Introduction to Business Economics. Economics is a science which studies about individual organization in a process of production, distribution, consumption. It is the general meaning of economics, and there are some few important definitions which may ask from the point of view of exam. So you have to remember the definition. Wealth definition. Wealth definition is given by Adam Smith in the Books of Nations. Important to material things, an inquiry into the nature and causes of wealth of nation. It is the book name. Main definition of economics, you can say accumulation, acquisition, expenditure of wealth is called economics. And another important definition is JB What is JB says economics is a science which studies about wealth. He says economics is a science which studies about wealth. Then Marshall definition comes. Alfred Marshall, wealth definition. What he says with material well-being definition. The principles of economics, he given primary importance to man and his welfare. According to Marshall, human welfare is primary thing, material study is secondary thing. He says that human welfare and human development is first, then material well-being. A.C. Pigou, he suggested and he supported Alfred Marshall's wealth definition, which is also known as material well-being definition. Lord Lionel Robbins, he gives scarcity definition, which we studied about when we are studied in our class 11th and 12th. Lord Lionel Robbins, scarcity definition. Science of choice making, an essay in the nature and significance of economic science. His definition imperialized on the choice of problem arises. It is universal but criticized as imposed. Economics is a science, universally applicable, systematic body of knowledge, ability to forecast, capable of measurement. Science is a theoretical, but art is a practice. Science which teaches us what to know, but art us how to do. Difference between positive economics and normative economics. In this also you will get a question in MCQs. It studies about only cause and wealth relationship. It does not pass any value judgment. Positive economics, what it is, what ought to be. It is a descriptive, it is a prescriptive. It studies about economic as a whole, individual economics of units of economy, microeconomics, small, macro, large. Individual units of economy as a whole. In microeconomy, we can see the in macroeconomics we can see the total employment, balance of payments, growth rate, etc. It is also called as price theory, slicing method theory. Macroeconomics is also called as income and employment theory, lump sum method. In macroeconomics, you will get to know the GDP, gross domestic product, national income. Central economics problems, what to produce, how to produce, whom to produce, what to produce, how much should use to produce. It is related to allocation of resources, capital intensive sectors or labor intensive techniques, how to produce, techniques of productions. We discussed in the past capital intensive or labor intensive. Whom to produce, to whom we have to produce the goods or services. First of all, what to produce, what we have to produce, and how much, how to produce, from using which techniques we have to produce, either labor intensive techniques or capital intensive technique. Whom to produce, for whom. In generally in society, we the manufacturer decides that a particular product which is sold to whom to produce. Distribution. In any economy, if the resources is allocated only for the production of consumer, the present consumption will be in future growth declines due to less capital good availability. Then capitalistic economy, it is also known as free market economy, laissez faire economy, uncontrolled economy, unregulated economy, unrestricted economy. Fundamental future is private ownership of property. In capitalism, the ownership remains in the hands of private. Profit is the primary motive in capitalistic economy. Private individual participation is highest level. Private sec- private price mechanism plays a key role. Income and wealth inequalities are high. Full employment is guaranteed, but there is no security. Business cycle fluctuations are high. Business cycle fluctuation means sometimes there is growth, sometimes there is expansion, sometimes there is peak, sometimes there is contraction, sometimes there is draft drought. Availability of substitute in the market are more. Generally, in capitalistic economy, there are the power in the hands of private owners, so number of people can buy and number of people can start businesses, startups, and they may produce product, different kind of product based on the quality and quantity, sustainability, market forces, and they will keep a view, and everyone create the resources according to the ability of their capital and give to the people for money. So there are more substitute in the market according to the needs of the individuals. High growth rate, the growth rate will be very much high. There are class conflict between employer and employee owner of the, there may be wastage of resources sometimes, and consumer sovereignty exists. Consumer sovereignty is very important in the business management. Socialism, it is also called as controlled economy, combined economy, centrally planned economy. In socialism, you will see that the state ownership of property existed because the government will control the ownership. Welfare is the primary motive. The main fundamental feature of socialism is welfare. Welfare is primary motive. Minimum role of private price mechanism. There is less role of price mechanism of private individuals. All the major decisions regarding to the price, everything is taken by the government and fixed by the government. Income and wealth inequalities are very less, but you cannot say in realistic there is full much of income and wealth inequalities. Employment is provided, there is a security in government, but occupation is restricted. No consumer sovereignty, there is no consumer sovereignty will exist. The buyer cannot sovereign himself. Less business cycles, limited competition, less growth rate, better utilization of resources, no monetary incentives will be provided. Domination by nepotism and domination. Mixed economy, coexistence of private and public sector. Capitalism and socialism equal to mixed economy. Dual pricing system, administered price structure, growth rate is moderate, less business fluctuations. So in India, you can take example as a India mixed economy. Capitalism, you take economy as USA, UK. Then second unit, theory of demand and supply. Demand refers to the reputation that a customer is giving to a product to a given price in the market in a given point of time. Suppose a mango is there in summer and a consumer go to the mango purchaser vendor and he asks for 10 rupees and the vendor says it is 15 rupees per kg, and the consumer again ask give to 13 rupees. It is the 13 rupees is the reputation that a customer giving to the product to a price in the market a given point of time. Determinants of demand, characteristics of demand, price of a commodity, P of X, income of an individual, taste and preferences, price of related goods, other factors, population segment, distribution of income, wealth, demonstration effect, bandwagon effect, demand function, functional relationship between demand of a product and various goods, P of X, Y, T, P of SS, and other sources, price of a commodity, income of an individual, Y is denoted as an income, T is equal to taste and preferences, prices of substitute goods and other sources, price demand, D of X is equal to F of P of X, price of commodity. When price decreases, demand will increase. You can see when price is 5, the demand for product is 1. Individual demand schedule, market demand is obtained by horizontal summation of individuals demand of a single commodity, and the demand curve is curvilinear. um Law of demand, old and new buyers, law of diminishing marginal utility, income and substitution effect, the multiple uses of a commodity, exemption to the law of demand. There are some exemptions. Given goods are exempted. Veblen goods are also exempted. Necessities exempted. Rational and irrational, ignorant custom sometimes, irrespective of the demand and price of a product, the consumer will buy. So these are the exemption to the law of demand. And very important thing, changes in demand. Changes in demand due to changes in price. It is explained by the movement along with this same demand. Upward, contraction, downward, expansion. Changes in demand is explained through shift. Rightward shift, demand increases. Leftward shift, demand decreases. Here you can see rightward shift, demand increases. Leftward shift, demand decreases. Rightward up to downward movement, expansion. Upward movement, contraction. Yes, there are some important distinctions: competitive demand, substitute goods, joint demand, complementary goods, composite demand. A good can be combined for various purposes. Autonomous demand, independent and isolated. Derived demand, demand of one commodity depend on others. Price of production. Short term demand, it is due to frequent fluctuations in the price, the demand is relatively less. Long period, demand is relatively high. Film and industry demand. And price elasticity demand refer to the percentages of changes in demand is equal to percentage changes of a person. Electricity demand is measurable concept, quantitative, ed, changes in percent demand, quantity demand is equal to percentage changes in delta in price. So you can see The various example perfectly price elasticity demand. Inelastic unitary elasticities related goods and price method, geometrical method, arc method, midpoint method, and this is a formula where you can get 1 mark easily. Delta q by delta p into p by q for price method. Delta q changes in quantity demand is equal to changes in price into p by q. P original price, original quantity. The demand of fall by 196 when its price increases 5 to 6. Equilibrium price is also called as market clearing price. Supply curve is sloped left to right due to rationality of a seller. Law of supply does not apply in the case of land, rare goods, aquatic goods, and sellers irrationality. P by Q. Quantity demand price. And here you can see some example. Price, quantity, 20, 50, 18, 16. Delta Q by delta P changes in quantity demand 20, 50, 50, 60, 10. Changes in price 2. Delta Q, delta P 20, 50. There are some other examples such as characteristics of human wants. Some wants are some wants are substituted, some wants are complementary, some wants may be changed into hobbies, some wants different from person to person's necessities, conventionals, comforts always lies between necessities and luxuries. Luxury, superior and very expensive. Utility. The want satisfying capacity of a commodity is called utility. Anticipated satisfaction derived from a consumer before consumption, but the original satisfaction is only derived after the consumption of a commodity. Utility is a relative subject and subjective concept. It is always ethically neutral. There are terms forms of utility, form utility, size, shape, color, etc. You can see example of a utility when wood is in the state of unshaped, there is no utility, but the same wood is make into chair, cupboards, doors, so it will get utility. Place utility, so in a garden some flowers are bloom, at that time there is no utility, there is no demand for that product. But when the same flowers are brought to market and there will be utility, there the number of people will come and bargain and buy those flowers. Place utility, the place of the product decides the utility. Service utility, so there are many kind of services provided by the many persons. Time utility, for example, cold drinks will have more demand at the time of summer, umbrellas in rainy season. So most important thing is marginal utility. Consumer is very rational. Cardinal utility. 1, 2, 3 for ordinal. First, second, third, fourth. Law of diminishing marginal utility. Marginal means additional. So if a consumer consumes goes one more utility of a unit of commodity, the additional satisfaction derived from the consumption of additional utilities, commodity will decrease. Rational consumer, all the units of commodity are homogeneous, there is no time gap in the consumption. There must be standard units consumption, there must be standards. There are many forms that will be made on it. And limitation, money, hobbies, durable goods, and consumer supplies. The concept of originally Professor duped profile by Alfred Marshall, and willing price minus actual price surplus. So he is willing 50 rupees and actual price is 40. The difference is 10 rupees. It is called as consumer surplus. He will save that money. Ordinal approach. Hmm. It is important thing you have to note it. I'll just pause for few seconds. Make sure. Then budget line. This will also just thoroughly read it, and this will also thoroughly read it. Then pure perfectly oligopoly, homogeneous goods, differentiated, heterogeneous, open, free entry and free exit, closed, blocked entry, partial, large domination of firms, full, collusive, group of people formation and they fix a price, non-collusive, organized, syndicated group of people only for price. In a kinked demand curve is kinked. Business cycles. They are recurrent and occurs periodically. They occurs again and again, but not always in regular intervals, and they do not same length. Fluctuations are very common. Sometimes there is a expansion, sometimes there is growth, peak, contraction, recession, drought. So likely. And same, if sometimes there is expansion, there is not always expansion at all the times. They do not occur regular intervally. Business cycle is generally originates in free market economy. Free market economy is also known as capitalistic economy, regulated economy, uncontrolled economy, developed economies. The business cycle are pervasive in nature, widespread in nature. They are highly contagious. Business cycles creates a disproportionate effect on the sector, especially capital goods, consumer durability. Complex in nature, very serious on the well-being of society. There are four phases of business cycle: expansion, peak, contraction, drought, recession. So there is recovery before depression, drought, recovery after expansion. There is an increase in the business cycle. Then peak will reach. Then contraction. Contraction falls under the recession. Recession to depression or drought. Then again recovery, expansion. Then again peak, contraction, recession, depression. So these business cycle fluctuations are very common in any kind of economics, but they do not occur at regular intervals. Regular intervals in meaning, for suppose there is expansion, then there is a peak. So these two does not occur in the same format as I am studying and explaining to you. For this example, there is expansion. After some time, there will be draft. This is the study broken line in the middle. Characteristics: increase in national output, unemployment, aggregate supply, increase in sale profit, increased credibility. You can thoroughly read it. Peak, it remains the pop highest position. Cost of living increases, greater succession and fixed income earners. The economy cannot continue to grow endlessly. Peak occurs when economic growth reaches to a point where its stability for a short time the moves in a reserve direction. Contraction, there is a fall in the level of investment and employment. Recovery, expansion, peak, contraction. Producers do not recognize the pulse of the economy and they anticipated higher levels of demand. Supply is more than the demand. Depression drought. It is a severe form of recession. Growth rate becomes negative. No more jobs, unemployment. Individuals are left with very less income. Many companies forced to shut down their operations. Decrease in the interest rate. You will get a question from these indicators: leading indicator, lagging indicator, concurrent or coincidence indicator. Causes: internal cause, external cause. Internal cause: fluctuations, demand, changes in investment, changes in money supply, changes in government expenditure. Psychological factors: war, post-war, technological changes, natural calamities, earthquakes, population growth, etc.